welcome back to another episode of the Quantium Cast. I'm your host Ryan Kier, and in this episode, we're going to be looking at L Brands. They were the former full owner of the Victoria's Secret lingerie and beauty divisions, the pink brand and all of that stuff. Well, what has happened? They just agreed quite a while back to sell 55% of their stake in that brand, the Victoria's Secret lingerie and beauty divisions, to a private equity firm by the name of Sycamore Partners, and that was expected to close in the second quarter of 2020. But we found one heavy issue that a lot of people have been talking about. Some tabloids have brought this up and said there's a risk of this deal falling through or being subjected to, quote, lower and renegotiated terms. My thoughts are that the entire sector of retail and fashion brands have been some of the hardest hit on the back of this coronavirus pandemic that has been going on for quite a while and has the potential to go on for maybe even months. Now, with this deal that's been going on, a lot of people have said that the likelihood of it failing, or falling apart should we say, is dependent on something called the Material Adverse Effect Clause. This is something that could trigger a severe breakdown in this deal. If we zoom in on Victoria's Secret as a brand, they haven't been doing that well recently. If we look at their lease liabilities, we can see $2.5 billion, which is a huge amount. And to add to those woes, recently, they drew $950 million from their revolving cash facility. This to me kind of shows that they were in a desperate attempt to gather liquidity in times of duress. This whole coronavirus pandemic has led to stores closing, with no stores open and little hopes of having a solid logistical system to actually deliver for any of these online orders, with delivery drivers calling in sick. It's not just this as a problem. You've got issues with freight. Carriers can't go into the sky, or these planes are grounded at the moment. So the issue you've got is if you're trying to order some equipment, some materials, you're not able to complete your supply chain. So how do you expect them to have a solid delivery system in place? It's very unlikely that that can continue. You've seen firms like Ocado, delivery firms and all that, for groceries. They actually haven't been able to cope that well. Why is it that they've had a surge in demand? Their entire business model is one that should be able to cope with a sudden rise in demand. But frankly, it hasn't. And that is really unfortunate. But the thing is, if we go back to Victoria's Secret and L Brands for a second, in terms of sales, they've recently closed their Victoria's Secret e-commerce site. And that was so that they could sell hand sanitizers and soap. I don't think that's going to make up the amount of demand that they have lost. However, in times of macroeconomic stress like this, crazy conditions that a lot of people aren't able to operate in as businesses, to be able to have some kind of boost to your revenue, or at least cover a huge loss in your revenue, is great. For Victoria's Secret, it's a nice PR stunt as well. Then again, you can't get the amount of revenue you were getting with your previous products from something like hand sanitizer and soap. Not even supermarkets have been able to do that right now. To dive into some of the details of this deal, where the private equity firm Sycamore Partners bought 55% of the stake in Victoria's Secret lingerie and beauty divisions along with its pink business, we can note an implied enterprise value of $1.1 billion, as we mentioned earlier, 2 times EBITDA. But the issue that I've got is the debt to earnings before tax, depreciation and amortization is now at 3.5x. It used to be 3x, and that was only at the end of February. So we're talking 2 months ago, less than 2 months if you think we're only 7 days into April right now. I think that the debt has been downgraded. That to me is a bad sign. From BA2 to BA3, that's a little bit ugly. And it only gets worse. If we look at the last quarter's adjusted operating income, they actually lost $543 million for a company currently trading at roughly, what are we talking, $13.24. They've got a market cap of $3.6 billion. So they actually lost money. And just by looking at these bits of data, I can't see it likely for them to make any money. In strong market conditions, they had some issues with servicing debt, issues as a business in terms of revenue growth. They didn't achieve what they wanted to achieve. How are you going to do that now when most of the country is in lockdown. In fact, internationally, a lot of countries are going into lockdown. Many are yet to even join this whole brigade of lockdowns, which is very important, protecting the public health with the public in mind, which is important. But in terms of business activity, L Brands, for example, may not even see this deal close. If they do see this deal close, they still have 45% exposure in Victoria's Secret. So by Victoria's Secret having disruption to their business, it doesn't necessarily mean that their shares are going to rise even if this deal does go through. Because if they lose, 500 million? Think about the 45% share in those losses in terms of shareholder distributed income. I'd be super worried holding shares in Victoria Brands, but as a whole, in the entire retail sector, I would be worried as well. I mean, let's look at their shares. In terms of drawdowns, peak drawdown of 66%, from highs of around $28 a share to lows of just under $10. In terms of the current share price, they've risen something like 30% in about a week, with overall market conditions being choppy to the point where there's a 20% range. Imagine hearing about a 1,000-point rise in the Dow or a fall in the Dow of the same magnitude. Well, that seems to be happening every day. We're literally looking at the markets, seeing a 1,000-point price change towards close, at open. Stuff's getting super crazy, to say the least. So companies that are already vulnerable and have been underperforming, should we say, to the entire sector. Retail as a whole has been having a tough time, but there are some companies that have been able to push through in times like this. Now, those ones are the most vulnerable. We even talked about travel a couple episodes back on how companies in the sector are vulnerable. How would you expect a company that had underperformed in 11 years of a bull market from 2009 to early 2020 to actually outperform now when market conditions are worse than they were before? Companies like TUI that had been failing to deliver growth in terms of profitability are now going to struggle. Companies like Carnival with super tight margins are very vulnerable right now. If we look at Debenhams kicked the bucket before the entire phenomenon of a shutdown had even begun. Things are starting to get ugly. We need to be very careful. Local small businesses are vulnerable right now. Large businesses are exactly the same. 80% of staff costs are much higher in terms of the 20% burden that a business has to pay themselves, even though they might not be getting near to even a fraction of their previous revenues. Things are getting ugly, unfortunately. Now, to conclude with L Brands, the risks at the moment are, if this deal doesn't go through, of selling 55% of their shareholding in Victoria's Secret and Brands to a private equity firm by the name of Sycamore, as we've mentioned. Now, if this deal doesn't go through, L Brands is more vulnerable to taking larger losses because Victoria's Secret as a brand is going to lose a lot of money, especially with what's going on, the shutdown. We can only assume. You don't have to quantify it exactly, but think about it. If you take 45% of the future losses or 100% of the future losses, things are obviously going to be less painful if you're taking the smaller amount. It's essentially them mitigating their losses, spreading the risk. The problem is, a lot of people would talk about L Brands as a business that isn't really diverse in terms of its assets. Their income is kind of retail focused, and retail right now as an entire sector is super exposed, and I would only expect it to get worse depending on how long this shutdown goes on for. We could talk 2 months, 3 months. That's a quarter of revenue just gone. A lot of the times margins are very thin, something like 10-15% for these retail firms, so we need to be very careful. Although they've been up 30% over the past couple of days, people thinking that the whole deal is going to go through, there's still a lot of risk left on the table. So I would class L Brands as one firm that is very vulnerable, and I would kind of hold back. I don't know if you can short these firms when they've got such a small amount of liquidity, but I would probably edge towards shorting it as opposed to going long. The simple question that you should be asking yourself is, in times of a recession, should I be going long retail or should I be in risk assets like gold? Or should you just be in cash? Sometimes cash is even king. Only time will tell. I've been your host Ryan Kia of quantiumresearch.co.uk.